we're fortunate today. I'm sure everybody has been paying attention to financial markets over the last 4 years, 3.5 years, 4 years, and have wondered about explanations of why is it so volatile. Well, fortunately today, although we're not going to be able to cover everything in 60 minutes, we're going to get some insight from two experts on and two competing sort of alternative views. So we'll have a fuller idea about what's going on in financial markets after we've heard from Professor John Howe. John is to my right here. He's the Missouri Bankers Chair in the Finance Department at the University of Missouri. John earned his PhD from Purdue University in economics, and then went for the bigger bucks in finance. I should say trader or something, but you're too good a friend, I won't say that. Look, you're not here to see me talk, you're here to see John and Rex Sinquefield. Rex was one of the founders, the co-founder of Dimensional Funds Analysis. Rex has an MBA from the University of Chicago, and both of these guys have published in the top scholarly journals in finance and in business. So we're fortunate to have these two. Let's let them teach us about market volatility.
Well, I think I'm going to lead off. First of all, I appreciate you all being here today, and it's my pleasure. I thank the Show Me Institute for the invitation. Before I get started, I thought I'd tell a few small world stories. First of all, my first association with the name Sinquefield was with the Ibbotson-Sinquefield data, and anybody that is either a practitioner or an academic knows of the Ibbotson-Sinquefield data, and I've taught from many textbooks that kind of open with that data because they tell us a great deal about how stocks have behaved over time, how bonds have behaved over time, and so forth. So that's kind of the first connection here. The second connection is a less obvious one. My wife is a photographer and does a lot of artistic photography. And in 2008, she was awarded a $50,000 grant from United States Artists. And United States Artists is an interesting foundation because the foundation itself is supported by the Ford Foundation and the Rockefeller Foundation, but the individual grants, the $50,000, are given by individual donors. And the individual donor that supported my wife's grant is the wife of Suzanne Booth, the wife of David Booth, a former business partner, of course, of Rex's. So my wife was the 2008 Booth Fellow from the United States Artists. So the third one is that then my wife, the Sinquefields are supporters of the arts as well. The School of Music here at MU has received some of their support. And one of the people that's employed because of their generosity is a guy named Billy, whose last name now just escapes me. But anyway, Billy is working in the music school, and he and my wife have become good friends. They get together and share kind of artistic stories because talking to a finance professor about art doesn't really do much for my wife. So, and anyway, and then my last connection here, and my last small world story, is when I first moved to Columbia, my dental hygienist was your sister-in-law. And so, so anyway, it's kind of a small one. It doesn't really, I didn't have any conversations with her about the efficient market hypothesis because, of course, she was always kind of, what do you think about? And I couldn't reply because my mouth was...
John, her husband's.
I met Jerry just as he checked in, so that was great. So today we're going to talk a little bit about the efficient market hypothesis. The disclaimer, the obvious disclaimer is that I'm just speaking for myself, so I'm not representing MU, I'm not really representing the Show Me Institute. These are just kind of my ideas on the subject. But I appreciate the opportunity because I think the efficient market hypothesis is a misunderstood kind of thing. And by the way, I'm talking very fast because we will be done by 8:30, I promise that, okay? So, so the efficient market, this is a great opportunity for me to kind of discuss the topic, which I think is misunderstood quite a bit. So, first thing we might do is start with the definition of what an efficient market is. And our most basic definition is that a market is efficient if the prices of assets traded in that market fully reflect information. Fully reflect information. Now I want to come back, what I'm going to do is talk a little bit about this concept, and a little later in my talk, which won't be very long from now, we'll talk about the actual evidence about that, how we would know an efficient market if we saw one, so to speak. But this is our kind of first definition. Prices fully reflect information. I will say that the focus of my talk today is going to be on financial markets, But the concept of efficient markets applies to any kind of market. It applies to real estate markets, it applies to labor markets, it applies to currency markets, and so forth. So the idea that I'm trying to introduce today is really quite a general idea, although the focus will be on financial markets. So there we go. So this is our first kind of definition. And the next thing I'd like to do is say, why is this important? I mean, why do we care about whether markets are efficient or not? And I think there are at least two answers. By the way, as fast as I'm going, I'd be happy to entertain questions as we go along, okay? I mean, I've got 12 slides, and you say, well, that won't take any time, but remember, I'm a professor, so I can talk about any one slide for 10 minutes. I'm not going to do that to you, but anyway, so I'd be happy to entertain questions. Slow me down, ask a question. And there's certainly, I'm going to leave time for questions and answers as well at the end. So I think there are at least two reasons why the question of market efficiency is important. One is at kind of a broad economy level. And how many people, I know there are at least 3 colleagues from the MU's econ faculty here, but many of you, how many people have taken a microeconomics class, even if it was some long time ago, okay? So one of the things we know from microeconomics is that if markets are functioning well, prices serve to allocate resources in a very efficient way. That is to say that they allocate resources to their most highly valued uses. You may have heard that phrase way back when. I know for some of you these are not fond memories of microeconomics, but anyway. So at the economy level, whether prices are correct is very important because we're kind of squeezing the most out of our scarce resources if prices are correct, because then prices are the allocating mechanism by which scarce resources get allocated throughout the economy. So, and this, I'll come back at the end, the question of market efficiency then has some policy implications for the economy as a whole. So at the broad level, there is some importance there. At the individual level, and this is maybe more what you can kind of take away from today, that if markets are efficient, and I'm not yet taking a stand on this, I'm going to by the end of my talk, but if markets are efficient, then it means that you and I as individual investors can't consistently beat the market. Okay? Now, this is actually kind of a nuanced idea. And this is one of the first misunderstandings about market efficiency. Many people believe that they believe the following: if markets are efficient, I can't make money in the market. And that's not correct. If the markets are efficient, what those markets offer are returns that are commensurate with the risk that we're undertaking. Okay, so and this is what I call a normal rate of return here. Okay, so basically, because people tend not to like risk, and that risky assets tend to offer a positive return as a reward for owning those risky assets. Okay? So the question of beating the market is not whether I can make money in the market. The question of beating the market is whether I can make a rate of return which exceeds the rate of return I should have made for the level of risk that I undertake. And that's an important distinction. And what the efficient market hypothesis says is that on average you're going to make a rate of return which is proportional to the risk that you're undertaking. You're still going to make some money in the market. It's not, you're going to make zero, but you're not going to make a disproportionately high rate of return if markets are efficient. So we have these two kind of ideas about why this is important. One again at the broad level and one at the individual level. Comments or questions so far?
Are there any underlying assumptions in all this that you haven't stated?
Well, let me try to answer that question. He was asking about assumptions. So let's talk a little bit. What I want to talk about is the sufficient conditions for efficiency. Okay, so basically, economists talk about necessary and sufficient conditions for something to occur. So I first of all want to address the question of sufficient conditions, and I think this will get at your point, but if not, raise your hand again, okay?
Okay.
So the question is, a sufficient set of conditions means the following. If I observe this set of conditions, then I get, in this case, market efficiency, okay? So let me give you these a sufficient set of conditions for market efficiency. First of all, that there would be no transactions costs. And what we're going to do here is tell a quick story about a very idealized market. And I think this might be in the back of your mind when you ask this question. So we're going to tell a story about a very idealized market. And so no transactions costs, and I know even when I trade, I pay whatever it is, $7, but that kind of thing in this kind of idealized market doesn't exist. No information costs. In this idealized market, everybody's very well informed about what's going on because it doesn't cost anybody anything to be very well informed. And so again, I'm just going to talk about these are sufficient conditions. Many buyers and sellers. So let me take you back to, again, microeconomics again. Many buyers and sellers kind of sounds like what economists call the perfect competition model. But basically what we're going to be telling here is this idealized market story where there's a lot of competition. And it's really the competition that's going to lead to the fact that everything's priced correctly. Let me just add one more here. This is actually just general. No frictions of any other kind. Like, for example, another friction would be taxes, for example. So we have this very kind of idealized market, and we know the following, and this is completely among people who agree or disagree about market efficiency. This is a logical statement that no one disagrees with, and that is that if these conditions hold, then the market is efficient. Because nothing can be mispriced for very long anyway, because everybody knows it's mispriced. It doesn't cost them to get in and buy it if it's too low or sell it if it's too high. So under these very idealized sorts of situations, the market will be efficient. This is a logical statement. Again, not subject to disagreement by anyone. So what we have here is essentially a very competitive market. And another way of thinking about this is competition bids away those abnormally high returns. If they exist at all, they exist only for a very short period of time because of the competitive nature of such an idealized market. Now, by the way, the no frictions idea is somewhat reminiscent if you've had a physics class, and physicists often talk about frictionless surfaces. And so the analogy here is quite purposeful on the part of financial economists. And very often physicists will make calculations assuming a surface is frictionless. I remember in my high school physics class I had one of those air table kinds of things where we knocked things around trying to predict where they were going to go. And it wasn't a purely frictionless surface, but it served as a good approximation. Okay. But what we have set up here then is a logical statement of the following form. And that is, it's kind of an if A, then B kind of statement. That if we see these things, now I know I've asked you to suspend your belief or your disbelief for just a minute, but if we see these things, then markets are efficient. Okay, so that's the logical construct. So now we're doing Logic 101. So we've done Micro 101, Physics 101, and now we've done Logic 101. So this is a statement of if A, then B. Okay. Now, all of you are saying the following. Well, hold it. John, there are transactions costs, there are information costs, there are frictions of all sorts, okay? So we started with the statement, if A, then B. If the sufficient conditions hold, then we get efficiency. Now let me ask you, what happens if we observe not A? Because when we look into it, you may think that I'm just an ivory tower, pointy head kind of academic, but I'm willing to look in the world and say, no, I think there are transactions costs. I think there are taxes. I think there are information costs. Okay? So we're observing not A. Right? That is, we are observing that markets are in fact imperfect. Okay, so what can we say just from the first week of logic between if we observe not A, what can we say about B? And of course it's tempting to say not B, but that's not true. That doesn't hold up because there may be some set of conditions that we call C that also lead to B. Okay, so just because we observe that markets are imperfect doesn't mean that we can conclude that they are inefficient. Okay, so this is just kind of a logic argument here. So let me say the following. And lots of people make this mistake. So in terms of like I said, I'm happy to have the forum to talk about this because a lot of people say, well, you make all those assumptions about perfect markets, but we know markets aren't perfect, and therefore markets are not efficient. But that's a logical error. That is not correct. Okay, and so and I will tell you that the most egregious committers of that sin as a group are lawyers. And I say this at great personal risk because my dean here is a lawyer, but she of course would never make that mistake. Never. But I took a securities regulation. I had a semester off at MU. It took 2 classes in the law school. One of them was the securities regulation class, that claim was made. Markets are imperfect, therefore they can't be efficient. And I didn't correct the fellow, and I will say he's moved on, so you can't go through the current list of faculty at MU Law School to figure out who did that. But in any case, this is a common mistake, and one that I'm wanting to kind of try to dispel here. Okay? So the question then is, well, what are the necessary conditions for market efficiency? And that is, I think the answer, and I don't know if anybody else wants to chime in here, I don't think we have any really good idea about what's necessary for market efficiency. A common story is something like this, and that is, if we have a few smart investors with a lot of money, then when a stock, for example, is priced too low, they'll move in and buy it, move the price up to the level that where it should be. Or if it's too high, they'll sell it or sell it short, and they'll push the price down to where it should be. So that kind of story is, well, if you have some smart people with some money, not everybody has to be smart, not everybody has to be rational. All you need is a few rational people with a little money behind them to do that. And that might be a necessary condition, but I don't think anybody has a definitive answer to the necessary conditions for market efficiency. So we're going to eventually have to turn to evidence about this question. Okay? Any questions so far? While I get a quick drink. Okay. Well, I'd like to believe that all of us are going to be open to evidence about this question, as opposed to having some sort of prior that's absolutely unbudgeable, some belief that won't change no matter how much the evidence. So I will try to talk a little bit about the evidence, but at the same time, I need to begin to talk a little bit about how we would know an efficient market if we saw one. Okay, so that definition of prices fully reflect information is hard to operationalize. Like, what does that mean? I mean, we look out on the stock exchange or a currency exchange, and how do we know whether these prices fully reflect this information? So I want to break down that definition, prices fully reflect information, into two parts. And the first part is I want to talk about information, and I want to talk about what sets of information might be fully reflected in prices. And I'm going to talk briefly about the implications of these. And I don't know if I got to your question or not, but I don't have to assume perfect markets to still argue for efficient.
You talked to assumptions.
Okay. Yeah. Right. So first of all, we might talk about the information set that consists of past prices. And the reason this is of direct relevance is that there are many people that engage in what's called technical analysis, where they look at past prices, trying to find a pattern that will in some way repeat itself, and therefore they can predict which stocks are going to go up and which ones are going to go down. If markets are efficient, that information set is already fully reflected in prices and will be of no value in terms of helping us earn these high abnormal returns that we would all like to get. I will say as an aside, I would like markets to be inefficient, because then I could make very high abnormal returns, that is, returns that are higher than the level of risk, reward for the level of risk that I'm undertaking. But anyway, that's one set of information we might examine. We might also examine other kinds of public information. So we might look at press releases, or we might look at analysts' forecasts, or we might look at the financial information that is contained in financial filings with the SEC. And we can ask the question, this is where the evidence comes in, we can ask the question, is this fully reflected in stock prices? So we can look at this. And if it is, by the way, the implication is then we can't use it to make excessively high returns, because the implications of it are already built into stock prices. So fully reflect or built into are kind of the same thing. And finally, we might consider an information set that consists of private or inside information. And I'm going to talk shortly about, in just a minute, about the evidence on all this. But that's a very small set of information, but potentially kind of powerful or maybe exploitable information as well. Okay. So I've talked a little bit. This is really like a drive-by, a flyover kind of thing. But so I've talked about the information sets that we might look at. Now I'm going to talk about how we go about operationalizing the idea of fully reflect. So when we look at a market and we say, how do we know whether the prices fully reflect information? That's a tough thing to do. But there are really two kinds of approaches here. The first one is one that I've kind of hinted at, I think, as we've gone along here. And that is, we ask ourselves the following kinds of questions, and that is, can we create a trading rule, a rule that tells us when to buy and sell assets? Can we create a trading rule that will consistently give us abnormal returns? Again, for the last time, returns above and beyond that we would expect for the reward for the risk we're undertaking. So many of the tests of market efficiency take the form of trading rules. For example, can we buy, a trading rule would be something like buy all stocks that announce positive earnings. Or, I'm not saying that's a good one, I'm not going to recommend, but that's an example of a trading rule. A slightly more sophisticated one might be something like buy all stocks that announce earnings that are greater than analysts were expecting, or something like that. These are all examples of trading rules. And we are only limited by our imaginations. And I imagine each of you, sometime in your own life, has thought about a trading rule. Right? Oh, I think I should buy stocks that do X. Okay? So, and so the question then is the following. The way this line of research goes is that if trading rules generate positive abnormal returns, these high returns, then we say, well, the information that led to that trading rule is not fully reflected in stock price. It was still exploitable. We were still able to act on that information and make these abnormal returns. On the other hand, if a trading rule just generates kind of normal returns, I had that phrase on an earlier slide, and a normal return, then we say, oh, that information appears to have already been impounded in the stock prices or reflected in the stock prices. So that's one way that we go about trying to collect evidence about the efficient market hypothesis. The second way we do it is we often look at how stock prices react to the arrival of new information. So, for example, how quickly and accurately does stock price respond to the arrival of new information? Let's just stick to the earnings example. Suppose a firm announces an earnings surprise. Takes everybody surprised. Let's suppose it's a positive surprise. It's good news. It's much more than the analysts were expecting and maybe the market was expecting. This is new information, and the stock price should respond to that in an efficient market. But in an efficient market, it should respond both quickly and accurately. So there are two dimensions to these kinds of studies. Does it respond quickly? That's one question. Does it respond accurately in the sense, does it move to a new price that is fully consistent with this new information? So there are two studies there, two dimensions of these kinds of studies. And these, I want to talk, I guess, in just a minute about the evidence, but these are the two general ways that that we go about this. So let me just talk about what the evidence tells us. And this is my interpretation, but I think this is a fair representation, but anybody's welcome to disagree with it. There have been literally tens of thousands of studies of market efficiency. Probably, I don't know, it might even approach 100,000, because everybody can think of a trading rule to test. Oh, I'll go out and test this. And very often these things get published. Okay? I will tell you, just doing a simple count, that the vast majority of them are supportive of market efficiency. That is, it's very hard to find trading rules that seem to generate these returns, these abnormal returns that we would like. It seems that markets react quickly and accurately to the arrival of new information. Okay? One of my, there are several examples of that latter kind of study that I would like to tell you about. There are two of my favorites. One is, you all may remember the Challenger disaster when the Challenger blew up. Turns out the Challenger blew up during the business hours. The stock market was open when that happened. And as you probably know, rockets are made, the different components of rockets are made by different manufacturers. In fact, some astronaut, I don't remember who it was, is famous for saying something like, it's not a good feeling to be sitting at the top of something built by the lowest bidder. Okay? But there's more there's actually more than one bidder. So we have different parts made by different manufacturers. Okay? And as we discovered 5 months later in the famous congressional hearings, that the primary problem with that was the O-rings. Okay? And the O-rings, I can't remember who manufactured them. But it turns out that the company that manufactured the defective part effectively, its stock price fell literally within minutes of the disaster. And the manufacturers of other parts of the rocket, which were not eventually, were eventually decided were not at risk or at guilt of this accident, didn't change at all. So the market, now this is to me just a remarkable story, okay, that in fact the market sorted out what went wrong and sorted it out very quickly, and the price adjusted very quickly to that. So that's a remarkable story. Let me tell you another one, because when I come to the conclusions, I want to emphasize these again. Currency markets. Again, this is a financial market. It takes us a little away from the stock market. But the currency markets react to changes in monetary policy. And I could give you the long story about what determines exchange rates, and that would be long and boring. There are many things actually that determine exchange rates, but one of them has to do with monetary policy in the two countries. So if we think about the US dollar, British pound exchange rate, it depends on the monetary policy in Britain and depends on the monetary policy in the United States. Now, before I proceed, let me just say that an exchange rate is just a price too. Okay? An exchange rate is, say, the price of British pounds in terms of US dollars. So exchange, I haven't really deviated from my story here. An exchange rate is just the price of one currency in terms of another. Okay? So there have been a number of studies about how quickly currency markets respond to changes in monetary policy. And our expert on monetary policy is right here in the kitchen here. But changes in monetary policy should change exchange rates, especially if there's surprises. And most of the evidence, my favorite study on this, shows that currency markets change the prices, that is the exchange rate, on average in about 40 seconds of the announcement of the change in monetary policy. So is it instant? It is not instant. Okay? It takes all of 40 seconds. It might even take a minute for this price adjustment to take place. Okay? So in some sense, is the market absolutely perfectly wonderful? The answer is no. It seems to take on the order of a minute or so for these price adjustments to take place. On the other hand, when we think about implications, as we're going to get to shortly here, it's still a pretty fast reaction, and it turns out to be pretty accurate. That is, there appears to be no overreaction or underreaction. It seems to be accurate. Okay. Now let me just talk something that I think Joe in the introduction mentioned. Can't help but having read something about the financial markets since especially late 2007, somewhere in there. Okay, and so I think this is an interesting question. Did financial markets work well during the crisis? Actually, I personally again, my view is I'm not sure that the financial crisis is exactly done yet, so maybe it should be in the present tense rather than past tense. But in any case, and one of the concerns that has been voiced in the public press a lot is that the prices were very volatile during the financial crisis, and that somehow this volatility was a negative, it was a bad thing in some fashion. And I guess my take on this is that if the economic fundamentals, if the underlying economy is somehow now more volatile, then it is entirely appropriate for prices to be more volatile. That is, they're trying, if prices are efficient, if markets are efficient and prices are reflecting the underlying economic reality, the underlying economic reality becomes more volatile, then prices ought to be more volatile. So volatility is not in itself a bad thing, and it's certainly not evidence against the efficient market hypothesis. And my take on it is that, markets were pretty volatile, but kind of justifiably so, and because there were many kind of interesting events. So anyway, actually, let me digress, since I'm keeping us on time here. I'm going to be done shortly, but I know that at least 3 people in this audience are saying, well, this story can't be right because Warren Buffett exists. Okay, so I want to talk very briefly about Warren Buffett, obviously a phenomenal successor. Am I right? Did I get to? You were thinking that? Yeah, something like that, right? Okay, so let me tell you a quick story about Warren Buffett. Let me do the following thought experiment. What if I took 10,000 students from MU and I gave them each a fair coin, okay? And I had them flip it 30 times. And so the fair coin is designed to be kind of a random process, 50% chance of heads, 50% chance of tail, and so forth. Okay? And then I asked the question, how many times did I say 30? 30, thank you. Okay, so we have them flipped 30 times, and what are the chances that at least one person is going to flip heads 30 times in a row? And the answer, I didn't do the calculation before I came here, but it's not a bad chance. There's some chance that somebody's going to flip 30 heads in a row. Okay? And I think of that as kind of being like 30 years of doing good investment decisions, right? Something like that. That's the analogy I'm drawing here. Everybody with me here? So I'm thinking, like that's an up year. A heads is an up year. Okay? So the problem here is then a couple of things. One is, if we looked at this person's track record, we would be tempted to say, wow, this person is a pretty good coin flipper. I mean, they came up heads 30 times in a row. And if you're following the gist of my story, you know that the probability of a heads on the 31st flip is just 50-50, like it's always been. Okay? And you couldn't blame the person for believing that they were, in fact, a pretty good, I've got some skills here, I can flip a coin really well. Okay? But what this really, this thought experiment is supposed to underscore is the difficulty of separating out luck from skill. And really, that's why people continue to disagree about the efficient market hypothesis. You can say that Warren Buffett is skilled. One author, not me, in the journal Portfolio Management said, given the number of investment advisors, hedge fund managers, and so forth, we kind of expect a Warren Buffett to show up in the data once in a while. That's not at least conclusive proof against the efficient market hypothesis. Okay? And my final kind of observation on the evidence is that that for some reason people's prior beliefs tend to move very slowly. Like if you think markets are inefficient, I'm not going to convince you otherwise today. And if you think they are efficient, then I've been preaching to the choir, so to speak, on that. So, but I would just encourage you to think about the evidence and collect the evidence. So it sounds like I've been on my soapbox at this point, doesn't it? I've been preaching about efficient markets, but I want to get up on a bigger soapbox, as it were, and I would like to say the following. And just because it's a captive audience, you can't walk out at this point. Okay? I would like to say that the common wisdom, although I think it's wrong, is that the financial crisis was a failure of free markets. And my response to that is that the markets that were primarily at the core of the financial crisis, which would be the housing market and the mortgage market, which are closely related, obviously, were not at all free markets. They're in fact heavily regulated markets. And in fact, there's a case to be made, that would take another hour, but there's a case to be made that many of the rules and regulations and laws in those markets set up what we financial economists like to call perverse incentives. Now, my wife hates that phrase. She said that's a stupid phrase, but I think economists like to say perverse a lot. So we say perverse incentives, okay? And a perverse incentive is one that leads someone quite rationally to make decisions that kind of ex post seem kind of stupid. In this case, to take on a lot of risk. But we're not talking about stupidity of individual actors here. We're talking about people responding to incentives, responding rationally to incentives. So I'm going to come down generally, I'm going to get off my soapbox in just a minute, but I'm down on the side that really many of the incentives that led to the financial crisis were in fact policy failures rather than free market failures. And I think nothing could be more important in thinking about what sort of change and regulation we need going forward. Because if we think markets have failed us, that takes us down one path. If we think policies failed, that takes us down another path. And those are quite divergent paths. And I think this is a debate that I hope is still continuing, but I'm not optimistic about what I've heard so far in the public arena. So, this is my last slide, and we'll have about 15 minutes. Let me summarize, first of all, conclusions. I think the vast majority of evidence supports the notion that markets are efficient. It's very difficult, especially for us as individual investors, to beat the market. I will say, going back to that, remember that private inside information? I think even the most ardent believers, Professor Gene Fama, for example, at Chicago, would probably say, no, there are times when private information is not fully reflected in stock prices or any other kinds of asset prices. that would be a very strong form of market efficiency. And I'm not sure that anybody really believes that. But the other two information sets on that slide, the public information, including the past prices, the studies are very supportive of the notion that you can't use that information to make abnormal returns. So that's the conclusion that I want to draw. Again, kind of going back to the competitiveness of financial markets. This picture reminds me, I had the good fortune of visiting Goldman Sachs trading floor back when they were in the World Trade Center, so this is some years ago. And I remember seeing traders sitting at desks like this, and these people they needed no permission to invest up to $50 million in a trade. And they had very low transactions costs. I think $7 commission on they had much, much lower transactions costs. They had information coming in real time from all around the world. And it occurred to me, I said, these are the people I'm competing against. Right? These are the people I'm competing against. Why do I think I have an advantage over these people? And I concluded that I didn't. And I would encourage you to at least think about that as a conclusion that might apply to you as well. Okay? Because financial markets come the closest to the kind of that abstract notion from micro of perfectly competitive markets. Many buyers and sellers. Information is not free, but it's low cost. I mean, you go on Yahoo, you go on Bloomberg, you go on and so forth. Information is very low cost. There are lots of well-informed people. There are lots of smart people. Okay? And that's who you're competing against when you do individual security selection. And you're competing against smart people with low transactions costs, better information than you are. And I think, wow. So I think one of the implications is, so how should we conduct our lives financially? Or maybe professionally? And I think the answer is, first of all, in terms of your own investment, this is my advice, this is what I think is the implications of market efficiency, is that you want to, first of all, hold well-diversified portfolios. You don't want to be picking individual stock. You want to hold well-diversified portfolios. You want to hold them in some sort of vehicle that isn't charging you a great deal to do it. This is where DFA was a major, maybe the innovator in this. Okay? And so you want to keep your expenses low, and that would include taxes, so you want your turnover in these vehicles to be low. You want to hold diversification, a diversified portfolio, because that reduces risk. And then you say, well, then rather than looking for individual stocks, what should I do with my time? My answer is, I think you're going to make a lot more money by investing in your own human capital. What is it where you have what economists call a comparative advantage? Okay? Are your skills best set against the traders at this kind of floor, or are they best spent figuring out a product or a service that will be valued in the market? And you don't have to be necessarily entrepreneurial to this. I mean, you can do this within the context of a corporation. But where are my skills best suited? And I think the answer is they're not best suited competing against the traders at Goldman and other places. I think where they're best suited is, where in some other product or service kind of thing. And I think you're most likely to be wealthy or become wealthy using that kind of thing rather than trying to find individual stocks that are undervalued or overvalued. And I think with that, I will stop.
Can I add 60 seconds?
Absolutely.
Well, this was excellent. Let me add just a little bit to the implications, because this is really how should you behave, how should you invest. Think of this from a purely selfish point of view. He went all the way and stopped saying you should just buy index funds, which of course is what you should do. Today, you can buy the entire market portfolio. You can buy the entire world market portfolio of publicly traded assets at next to nothing in cost. And there are many organizations now that offer portfolios like that. And all you have to figure out, and this is the hard part, either you or your financial advisor, is how much risk should you take? And that's the tough question, and that's the one that academic finance has never been able to answer. That has to be answered at the individual level, and ultimately it gets down to intuition buttressed by sad experience. The other thing is, and John started to touch on it, is the quality, if you really buy into this, then the quality of your life and the amount of free time you have goes way up. Because it means things like, I know I shouldn't say this, but, well, first of all, there's all sorts of ads about mutual funds and who are the hot managers now and what are 5 new stocks for 2012, and there's always these active managers, these active mutual funds being pushed all the time. You hardly ever hear an ad for, why don't you just buy an index fund? And, sometimes I like to compare the active managers, the stock pickers, the people who claim they can beat markets and then charge you very high fees if you get into their funds. I like to compare them to astrologers. And I realize it's not right to badmouth astrologers. So the second part of it is things like, I know I shouldn't say it, Investors Daily and all these investment magazines, forget them. Only thing they're good for is to roll up and use as logs in your fireplace. All these ads, there's still loads of channels on TV. I can't believe it. They're just talking about buying stocks. There's channels that chart stocks. It was known by the early 1950s that stuff is all hokum. And yet you can find a lot of that stuff on TV. It takes real discipline to say that stuff is all a bunch of bull. That markets really work. I'm going to get saved by the system. I'm going to be saved by markets. But that is really the bottom line. Once you realize that, well, you have a lot of spare time on your hands. When I was at the University of Chicago about 1971, and we were seeing this as the ink was still wet on some of the papers being written, the implication we all realized was this means don't burn the midnight oil looking for the next hot stock. You don't have to do that. Because whatever the next hot stock is, you're not going to find. So that's the bottom line implication. I think, John, you were fabulous. And I guess either one of us will take questions.
Well, as a student of monetary policy, before we get to the questions, I do have a model of Ben Bernanke's brain and will be willing to sell it. Let's talk later. So just to give an
Not much value there.
let's wait and see.
I missed the ad, Joe.
Give me a chance. Let's take a couple of questions. So, yes, Mr. A.
I have a question as to the process of how come then low vol strategies have persistency and have worked and back tested and they work. And how, if you look at time, that over the last 30 years, 30-year treasuries outperformed stocks. I mean, that's a long period of time. And that's low risk versus higher risk. And if you think when the capital asset pricing model, you should be paid for risk, you really haven't gotten paid for a long period of time. The other aspect is that market information and prices really reflecting, or are they being manipulated? And I say manipulated by the Fed manipulates prices. And then the information from them being low cost is that unless you can pay $10 million to have a co-located computer next to the exchange, you can't compete with people like that.
Well, there's several possible responses, and I'm just trying to choose from among them. The question. Well, the question I want to answer is haven't there been some trading strategies that seem to have generated abnormal returns?
On a persistent basis.
Yeah, on a persistent, right? Anything can happen in a transitory sort of way, but on a persistent basis. And one of the problems in testing market efficiency is the question of market efficiency is, can we make greater than normal returns? And then the question, and you indirectly raise this, is well, what's the right model of normal returns? And unfortunately, that question has not been fully answered. We don't have a model that's been widely accepted. The CAPM was an early one. It's kind of come out of favor, actually, in terms of some others. But even the others don't have kind of even close to unanimous support. And so what the problem here is, if we mismeasure the normal returns, then we mismeasure abnormal returns. That is, if we got the wrong benchmark, if the benchmark's wrong, then our ultimate measurement is wrong. And that's one possible response to the persistence of profits in a trading rule. I mean, the other one, kind of generically, is not only are the models that we have not very good, but they're missing something. There's some missing risk factor in them. And if we could just identify that, these would no longer appear to be abnormal returns, that there's some return for something that we're kind of missing the story on. That's a short answer.
Now, let me take the first part was returns have been bad for 30 years relative to Treasury bills. Well, you know, that is the nature of risk, unfortunately, and to paraphrase the license plate, sometimes risk happens. And it's happened for a long time, like in Japan. In 1990, the Japanese stock market was at 40,000, the index. Now it's right around 9,000. We're going on 22 years. So this will happen. It hasn't happened over long, extended periods that correspond to most people's life cycle. But it could.
Yeah, I mean, the thing is, these are, the returns are not distributed. There's very few of those type of returns, but they seem to be coming more often and persisting for longer periods of time, such as Japan.
Mr. Roper.
I know you've been talking about an efficient market for individual securities. I'd like to ask a slightly different question, dealing with the market as a whole. See if you feel a little differently about that. I well remember the summer of 1982, where the market was really low. I think the PE was 7 or 8, and it was way down. And yet the tax cuts had gone into effect the year before. Paul Volcker was trying to slowly slay the inflation dragon, and yet the market was really down to that low level. It obviously took off gangbusters for really about 2 decades after that. Is there an argument to be made that even though the efficient market theory is conclusively proven on individual issues, it's not always so smart on the market as a whole?
Now, there's no argument to be made there. There's a lot of literature on that looks at the ability to use any of these variables that you described, PEs, price to book, whatever, to try to predict the next long-run return series, and all of those fail. And you know, even Fama and French came out with a paper that wasn't so good. And 2 fellows whose names I forget from UCLA looked at all these variables over a 100-year period and said there's absolutely zero evidence that you can use any of them to forecast long-term expected returns. And your best guess about what the long-term return is a simple average of a long past period of returns. You can't beat that forecasting method. That leaves a lot of uncertainty, but you know, that's the way it is in this world.
That was my best shot.
Okay, before we leave, let's thank Rex and John for their